Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds. This is a review of markets in May. Well, May was another difficult month for asset markets. Equity markets certainly caught up with that in terms of the policy accommodations that we've been resetting to over the course of this year. We did start to see a bit more negative correlation in the relationship between bond and equity markets. Obviously, bonds had led the sell-off in many asset markets, and we've made a lot of commentary around that as to the way that we believe it is a bit of a locomotive in the train of asset returns. And that's why it's very important to watch the movement of those markets and the expectation of central banking policies to try and calibrate where other things might reside in time. It's really important to kind of acknowledge now that the central banks are really getting on with actively lifting their interest rates. This has been expected by bond markets for the last 6 months. And in many respects, bond markets have settled down now as the realizations of these rate hikes are coming through the system. But what it does mean is that out there on Main Street, rather than on folks in Wall Street talking about this stuff, things are getting difficult quite quickly. And you're seeing that with very, very low consumer confidence readings. And that's really the world over. I mean, these rate hikes are a universally global thing. There was obvious reasons why inflation was high after the reopenings, but they've been turbocharged by the war in Ukraine and the global food and energy market disruptions that have occurred as a result of that, and the lockdown in China, which has added additional pressures on the supply side of the equation. Thankfully, as it pertains to inflation, inflation has been very elevated by a whole series of domino of things that have collided into each other. It should moderate from here on. Now, I say should because barring any more exogenous shocks, that's absolutely the way the outcome should reside. And we're already seeing that in things like goods inflation starting to dissipate quite considerably. Anybody that's been following results in US retailers like Walmart or Target have seen massive rises in inventory build, overstocking, and now discounting as a result of that. So goods inflation is taking care of itself, and capitalism and the supply lines are improving and solving those issues. What is more of a concern is that services inflation is still rising. A big part of that is rents, but everybody has an insatiable demand to travel, fuel, airplane, lodging away from home, all of these types of things are still rising and quite sticky. So there's a changing story in the inflation story. It should moderate over the balance of the year, and as we said, without any more exogenous shocks provided by geopolitical events or the like. Then the expectation is that US inflation will moderate down to around about 4%. Now, in doing so, that's still above the Federal Reserve and many central banks' stated inflation mandate policy levels. So it means that arguably there is still more to do, but I think central bankers will take some cover in the fact that the velocity and the momentum is now turning and moderating to the downside, and it probably can take care of itself because we are going to no doubt destroy a lot of demand in the process via these very aggressive rate hikes. With regard to those rate hikes, here in Australia, we've had expectations of 1-year RBA cash via bond market pricing up in the high 3%, 360, 370. That looks like an incredibly big change. We don't believe it's going to be realised, but certainly there is additional premium that is in bond markets in case we do get more unexpected events. But that's been quite extraordinary given that it's been about 50 or 60 basis points more in expectation than the rate hikes that the Federal Reserve in the United States would deliver. And obviously very different policy settings and inflation problems between the two nations. So it's not unsurprising to us to see the bond market really starting to settle down, and it's kind of found a new range here, thankfully. It's been an incredible sell-off. Both the speed and the velocity and the depth of the sell-off has been historically extraordinary. We think that has big join-the-dot moments to other asset classes in time, and it's very important to think through those moments. And where that becomes really prominent is in the refinancing of corporate debt. So the corporate debt is not tested until it must roll forward. These are not 30-year mortgages. They do mature, and at that maturity point, unless those corporates are willing to pay off the debt, then generally they like to reborrow and roll that obligation forward. And that has been a problematic choke point in previous cycles. We've talked about 2018 a lot, and clearly there was a blockage there that really changed central bank policy and was the pivot that allowed for a new bull market to kind of, or a new performance of risk assets. Thereafter, that's when the Fed went from hiking rates in 2018 to pausing at the start of 2019 to then cutting by the middle of the year. So that's the real pivot point that I think we're really focused on, because it's as those corporates come to market and are required to roll, knowing now that interest rates are so much higher in terms of the risk-free government rates, plus the corporate bond spreads, that can be problematic for the weaker of the pack. Now, the really interesting thing in that space is clearly a lot of really good and high quality names get dragged along in that moment, and that will provide wonderful opportunity for investors away from our area in government bonds, but that will be a fantastic opportunity to build up corporate allocations within the fixed income silos. So obviously we believe that there are levers to be pulled at this point in the cycle with regard to asset quality, with regard to liquidity, and then you've got to obviously navigate to the other side to find those opportunities. And I do think that is worth thinking about, because as we said, the rubber is really hitting the road in regard to interest rate hikes. They will come with consistency. They're going to be pretty prominent to get to neutral. And I think we can just take from neutral pre-pandemic settings. So for the RBA, somewhere in that 1.5 area, or maybe even slightly above, towards 2% by the end of the year. But certainly 3.5 or beyond looks a bridge too far. The implications for property, the implications for construction and employment are simply too dire. It would be too vast a hitting the brake moment. And clearly we're going to hit the brakes hard, but after that, we're probably going to need some accelerator as well. So we do expect that this is a fairly blunt instrument to really stop the economy for a period, take pressure off those inflationary impulses, control inflation expectations, and as it pertains through the wage system and wage setting, before there might be some stimulation again. But it is worth thinking through, because if we do have these market blockages as we've had previously, how do we clear them if inflation is still moderating but well above the targeted range? Obviously, in other cycles, we got to 2.5% federal funds in the United States before we had that credit moment in 2018. We're going to almost certainly be at 2% in July of this year, in a little over 6 weeks' time. And of course, the world is far more unstable today than it was back in the 2018 period. The central bankers cannot cut rates and provide quantitative easing if inflation is moderating from 8 to 6 to 4, wherever it might go. It's simply not possible. And so if we do have those blockages in the risk system, clearly that's when asset pricing is moving very, very quickly. Then it's much harder to put the safety net in under the market, lower the volatility, and then allow for risk to perform again very well thereafter. Now, that's not to say there isn't going to be wonderful opportunity. We know that there's going to be a lot of volatility as this year continues to move on, but it really is in the second half of the year that volatility can really get higher again in our estimations, because we're getting much closer to these tipping points that have caused problems in other environments. It's also worth thinking through that we're getting vast movements in things like currency markets. Japanese yen is absolutely flying at the moment in terms of weakening. These types of things have preceded other issues in the Asian financial crisis, LCTM back in the 90s. These big moves prior to the 2008 blow up, energy prices up. So all of these things are getting towards the stress points. We don't know exactly how and when the catalysts will trigger those moments. It's a very complex ecosystem, intertwined now in highly algorithmic and electronic worlds. But I can certainly tell you that if we continue to shock the system with the speed at which we're doing, then the probabilities of those events certainly rise. And that is something that is well worth thinking through with regard to portfolio allocations. Thank you very much.